Hey everyone, I'm Jono and welcome to Trading with Master Jack. In this video, we're going to be dealing with what is Forex trading. Now you're here because you've got an interest in trading with Forex. You've maybe heard of the great profits that many traders have made and the fact that you can trade with a little bit of money and get great leverage in it. So here we are. Now it is a big question. It is a big subject overall to understand, and it's quite diverse and can be complex overall. But you got to start somewhere, right? So in this video, I've basically taken as much information as possible and just put it all in a nutshell. And in this way, you can get a great overview of what Forex is about and what are the things to look at when you are going on your learning journey. And yeah, I'll definitely encourage you to continue learning from as many traders as possible. Read books about trading, learn about Forex before you truly engage in your own account, before you commit genuine money, real money, hard-earned money into trading with Forex, because as much as you can earn great profits, you can lose just as much in a matter of seconds or minutes. So it is a high-risk trading strategies. Overall, trading with Forex, leverage trading, CFD products, and it's not something that should be taken lightly, and it's not a gambling process. It takes time to learn how to trade Forex. So let's just jump right into learning some basics about Forex. What is Forex trading? It is a network of buyers and sellers. It is the means by which individuals, companies, and central banks convert one currency into another. The vast majority of currency conversions is undertaken with the aim of earning a profit. So basically it's buying one currency in the expectation that its value would appreciate, that it will get stronger or weaken in a country, and you can have the benefit of earning profits. Now, how do currency markets work? Well, you get the spot Forex market, the physical, which is the physical exchange of a currency, which takes place at the exact point the trade is settled, namely on the spot, or within a very short period of time. There's the forward Forex market. A contract is agreed to buy or sell a set amount of currency at a specified price to be settled at a set date in the future or within a range of future dates. There's the future Forex market, which is a contract where you agree to buy or sell a set amount of given currency at a set price and date in the future. Unlike forwards, a future contract is legally binding. Now, the ones I'd like to focus on, because that's basically where we as traders make our money, that is with spread bet and CFDs. Going on with the spread bet first. Spread betting is a derivative product, which means you don't take ownership of the underlying asset, but speculate on whichever direction you think its price will move up or down. A Forex spread enables you to speculate on the future price direction of a currency pair. A currency pair's price being used on the spread bet is derived from the currency pair's price on the spot Forex market. In other words, what the live price is of the Forex. Otherwise, where else would it come from? Your profit or loss is dictated by how far the market moves in your favor before you close your position and how much money you have bet per point of price movement. Now we'll get into the details of that per point of price movement, understanding how that is calculated and how that works out. Spread betting on Forex is provided by spread betting providers, but unfortunately, if you live in the US, spread betting is considered illegal, despite being regulated by the FSA in the UK. The US considers spread betting to be internet gambling, which is currently forbidden. Which, fair enough, because spread betting at the end of the day has got tax benefits in the sense that it is considered gambling, but it's ultimately not really gambling if you know what you're doing. That is the idea. But at the end of the day, though, they do see it as online gambling, and that's why it is not allowed there. And it has its tax benefits depending on your country's laws around taxing of earnings from gambling. Going on to CFD, Forex CFDs, That is a contract for difference. Is a financial derivative. A derivative product tracks the price of the market, or the market price, of the underlying asset, so that traders can speculate on whether the price will rise or fall, much similar to spread betting. A CFD is a contract, typically between a CFD provider, the broker, and a trader, where one party agrees to pay the other the difference in the value of a security between the opening and the closing of the trade, whether you had chosen that the direction would go up or down. In other words, a CFD is basically a bet on a particular asset going up or down in value. With the CFD provider, and you agree that whoever wins the bet will pay the other the difference between the asset's price when you enter the trade and its price when you exit the trade. A currency pair CFD price is derived from the currency pair's price on the spot Forex market, or at least it should be. If it's not, what is the CFD provider basing its price on? And therefore, when you do spread betting or Forex CFD trading, you need to do it through a regulated broker. Trading Forex CFDs gives you the opportunity to trade a currency pair in both directions, whether it's going up or down. You can make money in any of the directions. You can take both long and short positions. Okay, now that we've got the introduction out of the way, I'd like us to jump into the overview of Forex trading, and I'd like us to address 5 key questions. First one being, what is a base and quote currency? Number 2, types of Forex pairs. Number 3, what moves the Forex market? Number 4, how does Forex trading work? And lastly, why would you want to trade Forex? There are 6 key benefits as to why you should trade Forex. Number 1, what is a base and quote currency? A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quote currency. So let's look at an example. Here we've got the euro and US dollar, where the base currency is the euro and the quote currency is the US dollar. So basically, with 1 euro, you can buy 1.14091 US dollars. Number 2, types of Forex pairs. Forex pairs are split into the following categories. There's the major pairs, minor pairs, and the exotics. Now you'll be familiar with the major pairs, which forms roughly 80% of the Forex trading market. And that would be, for example, the Australian dollar and US dollar, the euro US dollar, the British pound US dollar, New Zealand dollar and the US dollar and the Canadian dollar, the US dollar, Swiss franc, and Japanese yen. And then we have the minor pairs, which is basically all the crosses. They're also known as crosses. That's just difference in terminology. Minor pairs, crosses of the other pairs here from the major pairs that crossing with each other, like the euro and the Japanese yen, the Canadian dollar and Japanese yen, the euro and the New Zealand dollar, etc. And there are said to be about 42 of them, give or take. But of course that would vary with your broker. Your broker doesn't always offer you all of the currency pairs that exist. They only trade with specific currency pairs, which is most commonly the major pairs, a bunch of the minor pairs, and some of the exotics. The exotic pairs would basically be like the US dollar and Russian ruble, the US dollar and Mexican peso, the British pound and South African rand. I'm sure you get the pictures, and all the exotic pairs of currencies. But they also tend to carry higher spreads because of their volatility, but that will also depend on your broker, again, on what type of spreads they offer, which is ultimately your cost in your trading. But that comes down to what your broker offers. Number 3, what moves the Forex market? The old principle we all know, supply and demand. The Forex market is made up of currencies from all over the world, which can make exchange rate predictions difficult, as there are many factors that could contribute to price movements. However, like most financial markets, Forex is primarily driven by the forces of supply and demand, and it is important to gain an understanding of the influences that drives price fluctuations here. So first up is the central banks. Supply is controlled by central banks who can announce measures that will have a significant effect on the currency's price. Quantitative easing, for instance, involves injecting more money into an economy and can cause a currency's price to drop. Second, news reports. Commercial banks and other investors tend to want to put their capital into economies that have a strong outlook. So if a positive piece of news hits the markets about a certain region, it will encourage investment and increase demand for that region's currency. And then, of course, market sentiment. Market sentiment, which is often in reaction to the news overall, can also play a major role in driving currency prices. If traders believe that a currency is headed in a certain direction, whether it be up or down, they will trade accordingly and may convince others to follow, increasing or decreasing the demand. Number 4, how does Forex trading work? Traditionally, a lot of Forex transactions have been made via Forex broker, but with the rise of online trading, you can take advantage of Forex price movements using derivatives like CFD trading. CFD trading is not just available in Forex trading, but also in stocks, commodities, indices, and ETFs. When you trade CFDs, which is contracts for difference, you buy a certain number of contracts on a market if you expect it to rise, or you would sell them if you expect it to fall. So it's two types of positions you can open up, as mentioned earlier. The change in the value of your position reflects in the movement in the underlying market. With CFDs, you can close your position anytime when the market is open. CFDs are leveraged products which enable you to open a position for just a fraction of the full value of the trade. Unlike non-leveraged products, you don't take ownership of the assets like with futures, but take a position on whether you think the market will rise, so going long, a buying position, or fall, going short or selling the position in value. Although leveraged products can magnify your profits, they can also magnify your losses if the market moves against you in the opposite direction. As we continue to go through how does Forex trading work, you'll be learning some new words, new terminology that you can add to your vocabulary. What is a pip in Forex? Pips are the units used to measure movement in a Forex pair. A Forex pip is usually equivalent to a one-digit movement in the 4th decimal place of a currency pair. So if the Euro USD moves from 1.14382 to 1.4393, then it has moved a single pip. The decimal places shown after the pip are called fractional pips or sometimes pipettes, because some brokers quote in fractional pips. So let's just illustrate this change of one pip. We've got the Euro USD going from 1.14382 to 1.4393. That is the 4th decimal place, and that move there is equivalent to 1 pip. The exception to this rule is when the quote currency is listed in much smaller denominations, with the most notable example being the Japanese yen. Here, a movement in the 2nd decimal place constitutes a single pip. So if the Euro Japanese moves from 105.362 to 105.372, again it has moved a single pip from the 6th to the 7th, because it works on the 2nd decimal place. But commonly, most of the currencies work on the 4th decimal place. Just to illustrate an example of the value of the pips, before the decimal place, 1 is represented by 10,000 pips. And after the decimal place, this 1 is 1,000 pips. The 2nd decimal place, the 4 is 400 pips. 3rd is 30 pips. 4th decimal place here is 8 pips. And of course, lastly, the 0.2 pips, or this can be called 2 pipettes, or known as fractional pips. Just to give some more clarification, what is a pipette in Forex? There are Forex brokers that quote currency pairs beyond the standard 4 and 2 decimal places to 5 and 3 decimal places. They are quoting fractional pips, also called points or pipettes, which is equal to a tenth of a pip. Just to illustrate this, the Euro and USD example again, you'll see now we are at the 5th decimal place, and that equals 1 pipette, going from 2 to 3. Now, you're probably also wondering, okay, great, there's these pips, but what is the value of the pip? How do I know how much is 1 pip valued at, or pipette valued at? Now, to determine the value of a pip, it's a bit more of a detailed process, and I'm not really a fan of making very long videos, so therefore I've got a separate video that you can watch, and you can see where I detail the understanding of pip in terms of determining its value. So you can have a watch at that video, and I'm sure you'll gain the insights there. Generally, I personally am not too worried about pips. Most traders are focused on gaining that 20 pips a day or 40 pips a day focus. But my focus generally is percentages based off my risk to reward ratio that I use on what the percentage is that I risk and to what I want in reward. And that's generally how I work my trades out. I do explain that in what is a trading plan, part 2 of 2, where we deal with entry and exit position, and I detail about stop losses and risk to reward ratios to use. So you can have a look at that one if you don't want to get too caught up on pips. But it is good to understand and know how the value of pips work. Generally, the broker does indicate to you, explain to you what the value of your pip is, because it varies depending on the leverage that you use, whether it be a leverage of 10, 20, 50, 100, 500, 1,000 even. So it depends on the broker at the end of the day. But if the broker doesn't illustrate that and you want to know, there's a way to calculate it. And I do have a separate video for that on how to calculate the pip value. Now, while most brokers offer zero commission trading options and no other trading costs really, they do, however, have the spread, which is their main cost to you. Now, what is the spread in Forex trading? The spread is the difference between the buy and sell prices quoted for a Forex pair. Like many financial markets, when you open a Forex position, you'll be presented with 2 prices. If you want to open a long position, you trade at the buy price, which is the ask price, which is slightly above the market price. If you want to open a short position, you trade at the sell price, which is the bid price, and that is slightly below the market price. Here's an example of the buy price. You'll see over here that is the market price, where it is at, and there is the buy price, what is being offered. And to work out that spread, basically, you take the price that they're offering you here, and you take that and you minus the market price. That is equal to 0.000305, which, as you will understand, the 4th decimal place, it has a spread of 3.05. Now the spread varies. It goes up, it goes down. It depends on the broker and what spreads they offer. And the volatility of the market can also increase the spreads. And that is to protect the broker at the end of the day. Here's an example of the sell or bid. Just move this one up. And there you have it. There is the market price, what the market price is trading at, and this is the bid price. And to calculate that, you would simply need to take the market price and minus the bid price, and that is the spread then. In this example, it is 4.8 pips. And here comes some more new terminology. What is a lot in Forex? Currencies are traded in lots, batches of currencies used to standardize Forex trades. As Forex tends to move in small amounts, as you've seen, 4th decimal place, lots tend to be very large. A standard lot is 100,000 units of the base currency. So because individual traders won't necessarily have 100,000 pounds or whichever currency they're trading to place on every trade, therefore almost all Forex trading is leveraged. Here's an example of the types of lots you get. You get standard lots, which is 100,000 units, mini lots, 10,000 units, micro lots, 1,000 units, and even nano lots, which are 100 units. It depends on what your broker offers in terms of that. Some brokers tend to have a minimum lot size of 10,000, which means you have to leverage your trades quite high in order for you to enter a position of holding 10,000 lots. What is leverage in Forex? So we've heard that word a few times. Leverage is the means of gaining exposure to large amounts of currency without having to pay the full value of your trade up front. So instead, you put down a small deposit, which is known as a margin. When you close a leveraged position, your profit or loss is based on the full size of the trade. While that does magnify your profits, it also brings the risk of amplified losses, including losses that can exceed your margin. Leverage trading therefore makes it extremely important to learn how to manage your risk. Now, you also get this thing called margin call. So say, for example, if you invested of your own money with $1,000, then if your losses reach a certain amount of the margin call, say the margin call is at 50%, then if it reaches half of your $1,000, then your position will close automatically and you will lose that $500 in loss because it's at 50%. And some brokers go up to 95%, where the margin call, where if your losses for that position reaches 95% of your $1,000, then it automatically closes the position. But you can opt for options where it carries on taking the money from your account, the remaining balance that you may have available, the equity that is available, which that is not advisable because that goes against the principle of managing your risk effectively. And as I've mentioned, I deal with that in what is a trading plan part 2 of 2, where we deal with stop losses and risk to reward ratios. Okay, so let's get into some more detail as to what is a margin in Forex. Margin is a key part of leverage trading. It is the term used to describe the initial deposit you put up to open and maintain a leveraged position. When you are trading Forex with margin, remember that your margin requirement will change depending on your broker, how large your trade size is, and what leverage you use. Margin is usually expressed as a percentage of the full position. So a trade of the euro and the pound, for instance, might only require 3.33% of the total value of the position to be paid in order for it to be opened. So instead of depositing £100,000, you'd only need to deposit £3,300. Example time. So let's look at leverage, a lot, margin, and spread from some brokers and some trading platforms that I use. The trading platform that we're using here is capital.com, who's also the broker. The pair that we're using is the euro and the pound. Basically, in terms of choosing your leverage with this trading platform, you go to trading options and you set your leverage there. Other platforms, you may have your options for leverage over there at the buy side screen, wherever you buy and sell, but in this case we set our options in the settings for each instrument that CFD instrument that you want to trade. In my case, the currencies we got out of 100. And look what happens when you put 1 unit in. If you try to buy 1 unit, it actually gives you this message. The size is too small, minimum is 1,000. That's a micro lot. Let's put in 1,000 here. And that's basically based on a leverage of 100. All we need is $11.43 to be able to buy this micro lot of 1,000 units. That's really not bad. So that shows you the power of leverage. A little more detail here. There's our leverage, and that's the trade. Obviously, it's fluctuating as the price fluctuates. Let's just have a look at this. If you buy 1,000 euro GP at the price of 0.91054, your trade size will be 910.54 pounds, or 1,143.21 dollars. And that's your margin there, and that's what you get from the broker. So this is actually really not bad. The power of leverage is great and allows you to make great profits. Now look what happens on top here. When we click buy, just keep an eye over here at margin. And there we are. There's our margin of 11.43. And that's our profit and loss. And naturally, our funds in total is there. And available funds that we still have to buy into any additional positions that we want to open up with any other pairs. Now, of course, one has to maintain your margin. If your loss with this particular broker, if your equity it's 50% in loss, then it can do a margin call where it closes your positions. So it's important to understand margin call, and if your broker uses that. Otherwise, have a stop loss to ensure that your equity doesn't get drained with the losses from your available balances. And here we got the euro and the pound again with IQ option, broker and platform in one. There we don't even put lot sizes. You just simply put the amount you want to invest, whatever you have, and there's the multiplier and gives you your volume there based off your leverage. So we'll just use $10 with a multiplier of 300, and there you see $3,000. Now the pip value, here they give you the pip value. Every change, estimated value for each point change, for each pip, would basically give you $0.33. So 10 pips would be $3.33. There's also auto close for profit taking and or losses. And here's a summary of our order if we click buy or if we click sell. And then we have the spread, which is 1.2 down there. So it's a very straightforward one actually. And now for the last one, number 5. Why trade Forex? There are 6 key benefits overall that I'd like to highlight. Number 1, the choice to go long or to go short, that is to buy or to sell. While you can go short on other markets by using derivative products such as CFDs, short selling is an inherent part of trading Forex. This is because you are always selling one currency, the quote currency, to buy another, the base currency. The price of a Forex pair is how much one unit of the base currency is worth in the quote currency. For example, in the Forex pair, the pound and the euro, the pound is the base currency and the euro is the quote currency. If the pound and euro is trading at 1.11768, then 1 pound is worth 1.11768 euros. If you think that the pound is going to increase against the euro, you would buy the pair, you would go long. If you think the pound will decrease in value against the euro, you would sell the pair. That means going short. Your profit or loss will depend on the extent to which you get your prediction right, meaning it is possible to profit whichever way the market moves. Now on to the second benefit. The foreign exchange market is open 24 hours a day, 5 days a week. As compared to stock markets, they only open up limited hours during the day. The Forex market can be broken up into 4 major trading sessions. The Sydney session, the Tokyo session, the London session, and the New York session. Now just to illustrate the market time frames and their overlapping, I use the GMT plus 0. Now you'll notice that there is the winter timings and the summer timings. This has to do with daylight savings. Now you'll see in winter, for example, Sydney opens at 9 o'clock in the evening based off GMT plus 0 and closes at 6 o'clock. And Tokyo opens at 11 o'clock in the evening and closes at 8. Now this is the best trading times generally, where the markets enter into the most volatility as well. But this was just a rule of thumb. It is not necessarily the be and end all. One can obviously plan and strategize and enter into your positions in whatever other time frames you like to use. And in summer you can see everything moves up 1 hour overall. The third benefit is high liquidity in Forex. The Forex market is the most liquid market in the world, meaning there are a large number of buyers and sellers looking to make a trade at any given time. Each day, over $5 trillion of currency is converted by individuals, companies and banks. And the vast majority of this activity is intended to generate profit. The high liquidity in Forex means that transactions can be completed quickly and easily, so the transaction costs or spreads are often very low. This creates opportunities for traders to speculate on price movements of just a few pips. Average global daily trading volume. Stock markets are over $212 billion, and in Forex it's over $5.1 trillion. The fourth benefit would be Forex volatility, because markets are always moving from low volatility to high volatility and back to low. And it is in those times when it goes into high volatility that you hopefully have a position where you can benefit the most with the highest returns. The high volume of currency trades each day translates to billions of dollars every minute, which makes the price movements of some currencies extremely volatile. You can potentially reap large profits by speculating on the price movements in either direction. However, volatility is a double-edged sword. The market can quickly turn against you, so it's important to limit your exposure with risk management tools. So you got to have a trading plan in place, one that you're confident in and one that works for you. The fifth benefit is, of course, the leverage can make your money go further. CFD options is leveraged, which can make your money go further. Leverage in Forex enables you to open a position on the currency market by paying just a small proportion of the full value of the position up front. And we had discussed leverage in some detail, and I really think that is overall a great benefit to use in Forex trading. The profit or loss you make will reflect the full value of the position at the point it is closed. So trading on margin offers an opportunity to make large profits from a relatively small investment. However, it can also amplify any losses, as we've mentioned before, meaning losses could exceed your initial deposit if you're not using any type of stop loss, or if there is not a margin call. It can take from your balance that is still existing in the account, that equity that is still available. So for this reason, it's important to consider the total value of the leveraged Forex position before trading CFDs. And now for the last benefit, you can trade a wide range of currency pairs. Forex trading gives you the opportunity to trade a wide variety of currency pairs, speculating on global events and the relative strength of major and minor economies. You can choose from over 100 currency pairs, including all the major currency pairs, the minor pairs, and the exotic pairs. It's important to understand that investing or trading in stocks, Forex futures, options, CFDs, or spread betting, and other financial instruments carry a high level of risk to your capital and can result in losses exceeding your deposit. And that's why it is important to invest in your education and in your understanding of whatever investment instruments, whatever financial instruments you want to engage in, whether it be the Forex, stocks or commodities, etc. It's important to understand all the risks that are involved and understanding what your broker offers. And overall, it is a journey that you must take. And if it's something that you want to engage in, it's something that you want to do, then it is important to invest in your education and understanding. And this can take time. And that's where patience is also very important. You got to be patient in your journey and do not rush it. Many platforms, many brokers offer demo accounts. And what's great about demo accounts is that they are connected to the live markets. And that's how you can, in a sense, sculpt your trading plan, how you can develop your trading plan based off that exposure with a demo account. We don't actually risk real money, but it's demo money. And in that way, you can develop your strategy and what works for you. And I would definitely advise you to do that for quite a bit of time, a month, couple months if you have to. It's best that you invest that time and effort in the beginning, and that will pay off in the long run, because ultimately you are learning a new skill. It is the skill of a trader. If you enjoyed this video, hit that like and subscribe button so that you don't miss out. Happy trading, and may the trend be with you.